Welcome back to the Investing Markets and Money podcast with the Armchair Trader. This week we're talking about the blockchain sector. Some of you will know a lot about it. Some of you will know very little. Joining us on the podcast this week, we have Blake Heimann, who's joining us from WisdomTree, where he's part of the quant research team, to give us a little bit more insight. Welcome to the podcast, Blake.
Thank you, Stuart. Thanks for having me.
Blockchain, that's a subject that, as I've said already, a lot of people won't know that much about it. From an investing perspective, I mean, WisdomTree, you guys are an ETF fund manager. How do you define it from where you're sitting in terms of what constitutes a blockchain investment?
So yeah, there's many ways to actually gain, I'll say, investment exposure to blockchain technology. Now, many people really just assume that gaining exposure to direct crypto is, the main way. Now, that is one way, but obviously there's also a lot of firms that are operating in the space that um, are using the technology to enhance their product and service offerings or even enhance their operations. So there's also the equity type of exposure as well, and then within that equity exposure there's a lot of different types of companies operating in different ways. So for example, you have what we call are those that are more directly engaging with the software, so those offering apps and services. The Coinbases of the world are really the easy ways, the simple way to think about it, or the PayPals of the world, the Squares or the Blocks that are, offering payments platforms that are using the blockchain rails or offering financial services that are using the underlying blockchain rails. And then the other side of the coin there is what we call the engagers, which are firms that are operating in the sense of more on the infrastructure side of things. And this typically ends up being the Bitcoin miners of the world, but you could argue also that the those that are doing staking or offering staking services for the proof of stake blockchains like Ethereum are also doing that type of, or providing that type of infrastructure that is generating fees for doing the validation of the actual blockchain network itself. And obviously those payments are coming in the form of crypto, but many of these firms choose to either hold the crypto on the balance sheet or sell it for dollars or whatever other fiat currency to essentially have that as a form of cash flow. So when we really think about this space, there's many aspects of the investment, and all of these areas have a lot of growth. It really just comes down to kind of what fits the best risk return profile for a particular investor, and also understanding where they view the most growth and potential being, as well as how comfortable are they with I'll say the metrics and the evaluation framework that comes into play in these spaces, because it's quite a different world when you're evaluating, say, a decentralized blockchain like a Bitcoin or Ethereum versus an equity company or a publicly traded company that is operating within the space using the blockchain technology for their current services offerings.
In terms of current trends and innovations you're seeing within the blockchain industry, are you seeing anything coming through that could present new investment opportunities in 2025?
Yeah, definitely. So we not only have I'll say a quite a big transitional period for this space, because with many of these firms operating really based out of the US having the regulatory or currently having this change of administration and regulatory environment that is proving to be more pro crypto and pro digital assets and pro just general blockchain technology. So with that, they're prioritizing the proliferation of this technology to disrupt traditional, I'll say, traditional systems. So, for example, I see financial services being a key area where this disruption could take place. So, when we're speaking about financial services, there's a few different use cases that I talked about before. The payments rails, or even just say taking traditional equity portfolios or fixed income portfolios, or even entire multi-asset portfolios, or even private assets, and tokenizing those exposures and putting them onto the blockchain to tap into the fact that now you have enhanced liquidity, enhanced transparency, and overall improved efficiency, because now you're moving away from a world of, say, Excel sheets and emails to now something that is essentially now on a shared infrastructure where you don't have all those additional barriers, I suppose, that kind of take place between all of these different functions. So the whole reason we have so many people working in operations in the middle office and the back office in financial institutions is to help manage a lot of these challenges. And as I said, it's kind of ran off of Excel sheets, email, and centralized databases. And if you could imagine moving a lot of that to shared ledgers, shared databases, which essentially is what a blockchain is, this could be quite a disruptive thing for capital markets. So I see that being, a really major use case, and maybe to pinpoint some of the specific innovations. The stablecoin use cases are quite interesting and exciting. There's now about 200 billion in US dollar equivalents of stablecoins on different blockchains, and some of those just being a pure, US dollar equivalent. Some of those also offering yield. So we're seeing the demand for yielding stable coins, or even just funds that are, say, tokenizing, say, a money market fund, to give investors that are more blockchain native access to the traditional financial markets to get that yield versus always being exposed to so the more volatile digital assets. So all of those type of things are where we're seeing some interesting applications. And another example might be what Coinbase is doing with their recently launched Bitcoin loans. So with this new regulatory regime in the US, they made the announcement to allow for people to deposit their Bitcoin and actually take out loans against that for, spending for whatever in their daily lives. And with that, they're also using decentralized financial applications on the back end that are plugged into these decentralized worlds, these Ethereum blockchains, et cetera, Solana, and these others that you've heard of, that really lean into the efficiency that I was talking about before. Because rather than, managing this lending book on their traditional systems through, a massive team and Excel sheets, which I'm sure they still have, because you have to be doing that at this stage to really, it's still early days. So they still have to probably have those cross checks in place, and there still is some aspect of that. But they're able to tap into the benefits of the smart contracts and the automation that takes place on the blockchain and being blockchain native with the lending protocols and lending services that are out there. And that really is, I would say, quite an innovative use case that is actually bringing the benefits of what people call decentralized finance to our centralized finance world. So it's decentralized finance on the back end, but on the front end, anybody else that's interacting with it, their experience would be completely the same. So I see that as being a great example of how blockchain technology and what we've seen in the decentralized world, moving to bridge with traditional financial systems to really innovate and lead to this disruption in all these efficiencies, liquidity, transparency that this technology offers.
And when you're looking at this sector, how is it possible to properly evaluate the long-term scalability and sustainability of blockchain projects?
Yeah, that's an excellent question. And this is where I think it comes down to, this is kind of why I alluded to at the beginning that, for the different types of exposures that are out there, different individuals, different institutional investors, et cetera, will gravitate to different areas based on their comfortability with the risk, as well as their comfortability with how they can assess these things. Because it's very different when you are, say, assessing, a digital asset or a cryptocurrency like Bitcoin or Ethereum or Solana, versus evaluating Coinbase's business model or PayPal's business model, or even a Bitcoin miner business model like, say, Marathon Digital. So at the end of the day, when you're looking at, say, the cryptocurrencies, the blockchain systems themselves, it comes down to user activity, the types of activities that are taking place. So not only looking at the number of wallets and transactions that are taking place, and also separating out what amount of transactions are, say, maybe automated bot-like activity versus actual human activity. And the second key question is that activity producing real economic value? People have gotten excited about what's been happening on Solana, and I think it's an excellent blockchain and has a lot of potential. But there's been a lot of activity that's been oriented towards meme coins. So with meme coin activity, not a lot of economic value there. Now we have seen PayPal actually launch their stablecoin, Pi USD, on Solana because it's extremely fast, extremely cheap for transactions. So that's now sitting at around 500 million in overall market cap for that US dollar backed Pi USD token. So there is so there are institutions moving into that space, and that's like a good example of, okay, there's a lot of, I'll say, um, probably not so productive activity on the happening maybe immediately right now, but there's a lot of users on the blockchain, which would indicate maybe people really like the user interfaces and it's really easy for general people to adopt. And if you're seeing institutions also move there to meet those users and providing a great service like PayPal or like US dollar stablecoins for cheaper transactions, you could see some of the benefits there. Likewise, for say Ethereum, there are institutions moving on chain that are tokenizing traditional funds, tokenizing private assets on the blockchain to do what we talked about here a little bit ago with this convergence of this decentralized world with this traditional financial world, and seeing that, okay, there's a lot of applications that enable I'll say faster and more efficient, say lending, or faster and more efficient trading, and these type of applications. And you're starting to see institutions move there. So there's these type of trends that are useful to evaluate to actually determine how much economic value and growth is taking place on these blockchains, and why, and the firms that are being involved in these places to capture this new market and increase their TAM, if you will. So there's this aspect of evaluating things from what is happening in that world, but there's also purely on the traditional equity side and the business side that what type of services are they offering and how much demand is there for that. So sticking with the Coinbase example, they're the key player for the institutional adoption of this asset class so far, particularly with what they've enabled through their staking services, what they've enabled through their custody services for the Bitcoin ETFs. Now, that's not a major part of their revenue at this stage, but they've also got this their own layer 2 blockchain called Base that plugs into Ethereum that they are running, and this is where some of that decentralized lending software that I was talking about is running. And just in Q4, they actually generated 24 million or so in profit from that blockchain. So not a major amount when you think about the general overall total profit that they're producing, but still a meaningful thing. And we see, and you start to put some of these metrics together to see the amount of growth happening in that space, and the fact that Coinbase is essentially one of the first movers into there. You can start to see how it's early days of this of this trend, and there's a lot of potential here. So this is kind of how I think about that from that perspective. And then if we take a step further back and think about the enablers, which were what we talked about before, being much more the Bitcoin miners, evaluating those type of firms and the growth there. Obviously, their revenues are directly tied to the adoption of Bitcoin and Bitcoin prices. But that is much more of a traditional equity evaluation. You're looking at the leverage of the firm to make sure that they are, what is the cost of actually mining a Bitcoin for that firm, given their energy cost, which is the key input for that type of business model, to know that they can pay down those interest payments on their debt to remain profitable, and determine, do they have a strategy of, say, mining Bitcoin, producing the Bitcoin and holding it on the balance sheet, and having that belief that will continue to appreciate over time, and as they continue to keep some of those profits on the balance sheet in the form of Bitcoin, that it will benefit the firm value in the long run more than, say, holding cash and deploying it to increase their scale or whatever it may be. Or there's even firms that are now kind of taking a little bit more of a diversified approach, given the computational aspect of their benefits of, say, the Bitcoin. So the Bitcoin mining aspect of things is very computationally heavy. They use certain types of semiconductors called ASICs, but are also those ASICs and that type of computational data center infrastructure is very useful for AI as well. So we've also seen a trend where some of these firms are diversifying and tapping into the wave of AI to offer AI training capabilities as well through their mining infrastructure. They're originally what was originally built as mining infrastructure, but at the end of the day, it's a data center with advanced computing semiconductor chips. So when you're evaluating these, you look at those types of particular use cases and particular business models, and think about things there, and try to pinpoint, where you think the most growth and opportunity is, and that's that's a very long-winded answer, but it covers how vast and how exciting and how interesting the space is.
You mentioned earlier on the winds of change that are blowing through US government at the moment, and that has had a direct impact on the way, I guess, the SEC is positioned around Bitcoin, crypto, blockchains, etc. And that was last year when we were looking at this sector. The SEC's posture was very much a price driver in a lot of these asset classes. What do you see as the sort of key regulatory challenges and risks surrounding blockchain at the moment, and how they are likely to evolve? I know that's a tough question to answer, but just from your perspective.
Yeah, no, Stuart, it's an excellent question. It's probably the key question that everyone's asking at this stage, given what we've seen so far. I think so. There's a few things, and I'll lean on what we've really focused on so far and what we've heard so far, particularly from the U.S. Is that so David Sachs, who's the newly appointed, what they're calling crypto and AI SAR, which I don't know how that's if and how that's a formal title or whatever it is, but nonetheless, he is tasked with essentially aiming to put the U.S. as a leader in these two technologies, and ensuring that the regulatory environment has this pro innovation stance. So what he has come out and said is that they're aiming to have stablecoin regulation in place within 6 months, which is very fast. Now that would be quickly followed by a digital asset framework, which would be a framework that clearly classifies, which is one of the issues that has been kind of one of the key areas of concern in the past from the regulators perspective, is classifying digital assets as whether they be I'll say a more commodity like instrument, or a security, or maybe it's art like an NFT, as well as understanding what's the proper way to actually issue these and what are the requirements for issuing these. So building out a nice framework there on that spectrum will be extremely helpful. On the payments side of things, it could be very beneficial, because now you have what could become a new, more efficient rails that payments are taking place on, that don't necessarily have, say, the 3% fee, or the 1 to 3% fee that you typically have when you're paying with your MasterCard or Visa everywhere you go. So that could be, and also you're not subject to maybe some of those sometimes extortionate fees when transferring assets across borders based off of, and also just the time that it takes. Like, I was listening to different people's perspectives and stories around this, and sometimes it took multiple days, and they had to like answer questions why they're moving this amount of money from the U.S. to the U.K. or vice versa. Now, as a U.S. citizen moving to the U.K., I've luckily have kind of limited how much I've had to move back and forth. But it is still very much a key question, and I have to be in contact with my tax advisors and whatnot to ensure that I'm, one, abiding by the rules, and then also, if I were to go about doing this, I would have many questionnaires and things to be filling out from the different financial institutions I'm plugged into. So it really just creates a lot of headwinds, which, I mean, come in the form of costs. That's a different additional headcount and additional paperwork that's being done at the institution. So there's a little bit of that regulatory capture that is maybe a little bit detracting from some of the value, and maybe kind of cutting into GDP to a certain extent. But with the U.S. potential there to be able to incorporate stablecoins as a much more prominent way to do payments, it could really unlock a lot of value that is currently being captured in these ways. So that's one area that could be quite exciting. And maybe moving back to the digital asset framework, just to really put maybe tie a bow around that in terms of the use case. Now, historically, the issue has been around these classifications, and this is why a lot of these lawsuits came from the SEC. Now, as we go forward and have a framework, it should really allow for a lot of these firms to, first, venture capital will re-enter the space as they see more opportunity for products to be built and actually meet product market fit at a scale where the regulator won't be coming after them with lawsuits, which means VCs will be able to have more exit liquidity. So you'll see more capital move into the space, more growth. The innovators that are, putting all their time and energy into these projects will be back there trying to achieve these type of goals and aspirations. So I think it really can create a very conducive environment if they do it the right way. And I would say, just to get to maybe the end state where we would know if we did it right, is if we can really get to a period of time where, say, I can, in a regulated manner, issue a token that, say, as an ICO for a small project that I might have. So say I want to start a photography business, for example, and say I don't have the capital to start a photography business. I want to, raise 5,000 USD or whatever it may be to buy the new latest camera and start, pay for whatever things I need to do that. If I can do this on the blockchain and do it in a regulated manner, and there's clarity around it, and you or anyone else that can see my project, can see the smart contracts, and can feel comfortable and feel protected by not only the transparency of the code and the benefits of the blockchain itself, but also from the regulatory environment that is kind of operating around all of this, to be able to invest and know that you are protected, whether it be through debt or equity, to be able to allow people to have that type of access to capital to then do these new things, I think is going to be very powerful for entrepreneurs in the space. So that's just really one example how all of this could come together. But I see the next 6 months being very, very exciting in this space, and it is a breath of fresh air compared to the last 4 years, particularly as a U.S. citizen.
Talking about security, is security still an issue for larger blockchain projects? Do we still face major threats in terms of things being hacked or other such risks?
Yes, so I think that this is definitely actually a funny story. I was actually doing another webinar podcast, and I had somebody reach out to me direct afterwards asking me about the transparency of the blockchain, because they had actually had one of their wallets hacked. Now, it's horribly, it's a sad story, but this is kind of sometimes the nature of being self custody and essentially having full control over your assets with nothing else, but the only counterparty you have is the blockchain and the software itself. So if you're not doing things the right way, there is risk that something could happen, and there's plenty of bad actors that still exist in the space that are aiming to take advantage of people. So I think we have to acknowledge that. Now, for the larger blockchains, the more prominent blockchains, your mega cap ones that have been around for 5+ years now. Now, the software itself, we can say is very sound, and it's open source. It's been validated and reviewed by probably at this stage millions of developers. So the actual, I'll say what is called smart contract risk in, say, like Ethereum or Solana world is very low, because that blockchain itself has been around for a very long time and has had minimal issues. Now, the new projects that are, say, launched on top of these blockchains, or separately, completely brand new other blockchains, may have more of the smart contract risk, because at the end of the day, the team of developers behind the project may not have actually caught every possible thing, and there are risks of hacks, and we've seen them in the past. We've seen exchanges that are like decentralized exchanges running on various blockchains being hacked because there is a security flaw in the protocol. So we do have to acknowledge it is still relatively early stage technology, and still have that. I'll have a little bit of that skepticism when we are, getting involved here. But in terms of the large cap and the most prominent ones, that smart contract risk is essentially close to zero. And then it really comes down to having the expertise when you are managing your private keys and managing your custody, or evaluating a third party manager of that custody to ensure that your assets and your investments are fully protected.
And when we're looking at blockchain as a sector, we obviously hear a lot about the coins, we hear a lot about the technology, less so the actual management teams behind some of these projects. From an investment perspective, how important are the management teams in evaluating the ability and the track record of people behind blockchain projects?
I believe very important. It's actually been interesting, given our WisdomTree's position in the market. We've been able to kind of, meet different business development teams and leadership people at some of these blockchains. And I think it's very important, because at the end of the day, there are, as it may be, as they're still decentralized, it started with a vision, and being able to identify, even in the decentralized world, the product market fit to really know what is a problem that needs to be solved in this place, whether it be, even just in the early days, reducing the barrier of entry through easier wallets, or easier, people throw around the word interoperability, essentially just meaning it needs to be more seamless to transfer assets across blockchains and use different applications. So that's why we see so many blockchains out there, is because there's a lot of trade-offs here, and there are certain, just like any other technology or app that you would use in your day-to-day life, there are certain, benefits tied to different ones. So you may choose to use, this blockchain or this app for, maybe for playing games, like for the gaming use case, whereas you might use another blockchain for your financial services use case, because it's more optimized for those type of things. Now, so founder vision and founder kind of direction in leading the team, whether it even be a centralized, or like in a traditional equity firm, or even in the decentralized way, using what they call the decentralized autonomous organization, the DAO governance structure that is executed on the blockchain, still needs to reach consensus around the direction and the vision of the team that is, at making changes to the code base, and updating it to get it closer to the stage where they are realizing those ambitions. So it's very important. I think it's really not that different from, say, the equity space, but the ways at which all of the ways at which these ambitions are achieved is a bit different, because you have this, I'll say, decentralized governance structure, in terms of managing how the plan is executed in the decentralized blockchain world, versus the centralized structure, which is, obviously you have your executives, you have your leadership teams, you have your board members, et cetera, on the equity side. So I would say it's probably a little bit easier on the equity side, because there is that centralization of leadership. But it comes with trade-offs on both sides.
And I just wanted to touch on volatility risks. I mean, obviously, that's been something that's been inherent within this sector for quite some time. What would you see? What would you say are the main volatility risks specifically within the blockchain sector?
So yeah, we are very aware that it is a highly volatile asset, which is why when we've done a lot of portfolio construction, portfolio analysis for various institutional investors. to come up with the proper allocation, because at the end of the day, it is their job and they are evaluated, and could be, if they have a bad year, they could be fired at the end of the year, right? And they don't. So they need to be very mindful about the volatility, the drawdowns, all the different risk metrics when including, even if it is the equity side, which tends to be, a little bit more diversified and lower volatility because of the construction and I'll say the diversity of the business and the business models that are a part of that ecosystem, versus say the cryptocurrencies or digital assets themselves, which exhibit high volatility as we've seen in the past, and sometimes high correlation amongst those assets in that group. So we really focus on having small allocations as a part of a broader multi-asset portfolio. And when I say small, it's really ranging in that 1% to 5% range. Now, none of this is a investment recommendation. There's no, full disclaimer, we don't do any of this investment advice, so it's not advice. But this is, we have some research that kind of orients towards this based off of risk and return trade-offs or risk return appetite. Now, the other aspect of this is when we kind of focus more on equity space, is as we talked about the companies that are the engagers, those are that are involved in the apps, services, kind of the product side of things, rather than say the Bitcoin miners or the enablers group. So those that are the engagers have a much more diverse risk return profile. Some of them have lower levels of volatility, lower returns, because they are operating a little bit more of a, say, stable business, say in the payments use case. At the end of the day, people are always going to be using payments. So it comes down to, their user growth on their applications and how much transaction activity is taking place. But, they're consistently capturing that small fee from the transactions. So that's one thing. When you're looking at, maybe the cryptocurrency exchange type of firm, that's obviously those revenues are going to be tied to how much volume is on exchange, or maybe how much activity is taking place, or how much demand there is for new financial products that are plugged into the blockchain, say, as I mentioned in the base use case with that Bitcoin loan concept. So that gives you kind of a broad spectrum there. And then when you look at the enablers, so those that are, say, the Bitcoin miners, just as an example, these are firms that are highly levered, take on a lot of debt to build out these crypto mining data centers, if you will. And with that, all their revenue is coming in the form of essentially minted cryptocurrency that is a form of payment for securing the blockchain. And those revenues coming in are quite volatile, and those costs, the cost structures, can be high based on the energy inputs, if it is the proof of work blockchain that Bitcoin is. So they're much more correlated to cryptocurrencies themselves, and because they're leveraged, because they have debt on the balance sheet and they are operationally leveraged to this, they tend to have much higher volatility. So even higher than cryptocurrencies themselves. So it is one of those things that you really need to be aware of, the volatility profile and the correlation of these assets amongst each other and amongst your other assets in the portfolio. So this is, the key things that we focus on when we are doing these portfolio analyses with our institutional clients. And it's very important for all investors to take into account these risks when investing in this space.
And just finally, I know we've touched on the financial services sector as a major beneficiary of blockchain, but are there any other sectors that you think could benefit from the disruption this brings?
Definitely. So at the end of the day, a blockchain is essentially a decentralized shared database that achieves consensus or agreement on what is the accurate version of the database through essentially computer science innovation through these consensus mechanisms like proof of work and proof of stake, which is what you hear people talk about with Bitcoin and Ethereum. So the world that we live in is requiring more and more data and is running on more and more data. And a lot of that data is very dispersed. It's in centralized databases. That are only owned by a particular firm. it's on an Excel sheet on my laptop or other people's laptops. So by bringing this data to make it shared, and it can be anonymized or uh, I'll say protected to a degree to limit access where necessary for whatever use cases. But that in itself can lead to major efficiencies, as I alluded to in the financial services sector, in terms of automation and transparency across all the different touch points of the data being data on the blockchain, and touch points, say even in the supply chain of a product being or say a raw material turning into a product, and all the different firms that have to touch it at a certain point in time to ensure that, okay, by the time that product reaches the end user, they can track that completely through the blockchain. So that's one example, but this concept of data being shared amongst many different players, and this shared level of trust in the data can really disrupt very many or significantly many industries going forward, just because of the efficiency of that. Now, maybe one other area that's really interesting, and I did mention gaming before, so I will pinpoint that one as even a third one. But another area I would maybe focus on just for a second here is this concept of decentralized physical infrastructure, which is sometimes called DPIN. And this area is really interesting because it's essentially where, if I have an unused a laptop or unused server that I want to either allow people to leverage the computing capabilities or even the data storage on, because it's being unused, I can connect that to a network, a blockchain, and essentially allow other people to use that and generate fees from that. So we're seeing applications that are doing that, like Helium is a very popular one that's doing that for internet service and cell service. So offering 5G and other 5G and other capability or access to anybody essentially walking on the street that would want to tap into my Wi-Fi if they wanted to, or tap and use a cellular network. They could do it if I wanted to plug into the Helium network to then generate fees for offering that service. So we're seeing that even now with the trend for demand for GPUs with AI, is that there are protocols out there focused on GPU sharing to enable this decentralized compute infrastructure, which actually is quite interesting as a potential competitor to the centralized alternatives, which are the hyperscalers that we're all aware of today. So it's still an emerging area, but is one that is very interesting and kind of gets a lot of headlines because it is one of those areas that directly competes with some of the biggest and largest firms that we probably many all have in our portfolios today as the Amazons and the Googles of the world.
No, I can see that. I think it's a fascinating area, and I think the technology is going to be supremely disruptive, and it's going to happen very quickly indeed. Um, Thank you very much indeed for coming on the podcast today and talking to us about blockchain, Blake. I think that it's the first one we've done focusing on this topic, and I think it's been really interesting to talk about it today.
No, thank you so much for having me on, Stuart. It's been a pleasure, and yeah, very very thought provoking questions. So yeah, looking forward to doing this again, and hopefully coming with some more exciting developments in the coming months.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news, and sign up to our free newsletter there.